Japan Market Daily. The previous completed session in Japan was a useful reminder that this market is no longer just a weak yen equity story. Japanese stocks did recover, but the currency move was the bigger signal because the market was digesting reported yen buying intervention. The Nikkei 225 rose 0.71% to 61,867.43, taking back part of the previous sell-off. USD/JPY fell to about 160.23, which means the yen strengthened sharply on the day. The US 10-year yield was near 4.66%, and the S&P 500 rose 1.66%. That combination tells us three things. First, equity risk appetite improved. A stronger U.S. stock market helped Japan stabilize after a difficult run. That is important because overseas investors often treat Japan as part of the global risk cycle, not only as a domestic story. Second, the yen is now the center of the trade. Reports citing people familiar with the matter said Japan sold dollars and bought yen. The detailed official intervention record for this period is still a later confirmation point, but the market reaction was already clear. The dollar fell, and investors had to rethink positions built around continued yen weakness. Third, the stronger yen cuts both ways. For a dollar-based investor, a firmer yen can improve currency translation, but for Japanese exporters, it can weaken the earnings benefit that comes from a cheap yen. That is why the Nikkei's rebound should not be read as a simple all-clear. The first major headline is the reported intervention itself. Yesterday's theme was Intervention Watch. Today's theme is what happens when that watch becomes reported action. Policy credibility can support the currency, but it also increases volatility around exporter assumptions. The second headline is Kioxia. An earnings preview put the focus on whether the stock can rebound after a deep pullback. The two watch points are NAND supply-demand and buybacks. Kioxia matters today because it gives the market a concrete technology test. If semiconductor names can attract buyers even with a stronger yen, the Japan story becomes more selective and less dependent on currency weakness. There was also a smaller macro headline around Ukraine moving closer to approval for poultry exports to Japan. It is not the market's main driver, but it fits the broader theme that import channels, food costs, and geopolitical supply links still matter for Japan's inflation backdrop. For overseas investors, the practical takeaway is to separate the equity call from the currency call. Japan can still benefit from global risk appetite and technology demand. But the hedge ratio, exporter exposure, and sector choice now matter more. A stronger yen favors some foreign investors directly, but it may shift leadership away from the companies that benefited most from a weak currency. The next checkpoints are clear. Watch whether USD/JPY can hold near the 160 line. Watch whether US yields move lower or stay firm after the Fed split. Watch for the official intervention data when it is published. And watch whether Japan's technology stocks, starting with names like Kioxia, can show earnings resilience. If equities keep recovering while the yen stays firm, Japan may move from intervention fear to post-intervention selective rotation.